Good evening and welcome to our third webinar of the Accounting and Finance Show 2020 series. Today we have a panel discussion which will be exploring strategies to mitigate risk and creating a risk management framework. This panel discussion will be moderated by Alok, who is the director at Crowe, and he will introduce you to our speakers and will lead us in a very interesting discussion this evening. Can I now ask our panelists to turn on their webcams and mics and join us for the discussion? While our speakers are getting ready, just a note for all our webinar attendees that you can ask questions throughout the discussion. Please use the Q&A box in your control panel to ask questions throughout. Alok will do his best to get round to the questions at the end of the discussion. Okay, so without further ado, Alok, over to you.
Thanks, Ryan. Good afternoon and welcome everyone to the exciting webinar on strategies to mitigate risk and creating a risk management framework. It's a very exciting topic, especially in these unsure times and where we need to have a comprehensive risk management strategy. It has always been the case, and especially during the pandemic and even beyond the pandemic times and across the world, across all the sectors, as it is very critical to protect the assets, the finances, and operations of the organizations where we work. And successful risk management will enable us to protect the reputation, credibility, and financial standing of the organizations. And, business requires taking appropriate risks, seizing opportunities to achieve success. And of course, our primary role will be to mitigate risk, promote and facilitate effective risk and opportunity management in support of value creation and value preservation over time. So this session, we will explore with our two distinguished panelists, whom I'll introduce in a second, as to how we can achieve this effectively. And we will be exploring around 4 sub-themes emanating from the topic, which is adopting data-driven strategy for risk management, and of course, analyzing possible scenarios and the risk involved with the use of analytics. And of course, reviewing financial risk, considering an inclusive VAT framework, and of course, developing suitable limit structures. And we would encourage you to come up with questions and put your questions in the Q&A box, and we will aim to respond to them as many as possible, and preferably towards the end of the webinar. And we look forward to a very interactive, a very exciting session together with my panelists. And without further ado, I'll just introduce them. And they are both with distinguished track record. They have held several positions, track record of wonderful accomplishments throughout their career. And the first one, our panelist is Mr. Tamil Ramados. He's a strategic finance expert, and he currently is working as manager financial analysis with Dubai Maritime Authority at Dubai. And our second panelist is Mr. Abdurrahman Benahoud. Mr. Abdu, he's working as head of finance at Steering Legal, a multinational firm. So now talking and diving straight away into one of the sub-themes, adopting a data-driven strategy for risk management. And before I dive deep, just a word about me. I am Director of Financial Services. I lead the financial services practice at Crowe UAE. And Crowe is 8th largest accounting and audit firm in the world. And we have a presence in 130 countries and based out of, headquartered in New York. And we are present in the entire Middle East region as well. So adopting a data-driven strategy for risk management. When we talk about data-driven strategy, I mean, we know that companies consider analyzing large chunks of data, and there's a lot of data around as part of the risk management strategy. So it can be very daunting for everyone as to how to go about doing it, as to what it entails, so on and so forth. And it requires investment in the right capabilities, the right people, the right processes, and of course, technology. And importantly, the alignment of the goals and the opportunities concerned. And the companies are normally, there is an increasing trend to adapt the data-driven approach, especially when it comes to risk management, so that they are continually able to define and redefine what their business risks are, rather than using a traditional annual or even a periodic risk assessment cycle or an exercise, And we all aware that large volumes of business data exist, large volumes. Now, ideally, they should be analyzed in accordance with the strategic risks and, of course, in partnership with key stakeholders such as the senior management and, of course, technology, so on and so forth. And when we talk of technology, technology is a key enabler, which I have always believed in. And we are now increasingly believing in that. So emerging technologies, whatever they enable a diverse form of data creation, and their integration with traditional data is generating again and again voluminous information for the organization. And businesses, especially the small or even the large businesses, will have the capabilities, will come to that, will endeavor to derive valuable insights by processing and analyzing when we talk of big data. So efficient application of big data and analytics is very critical by enhanced assessment of emerging risks. However, there have been efforts by various enterprises to gain competitive advantage. They have not very well succeeded in the given space. And the reasons are many, which we will try to uncover during my questions shortly. And according to ITC, only 22% of digital data was a candidate for analysis, while less than 5% was actually analyzed. So, however, the key is to use data, rather big data, as a key driver in risk management, with a view to assess the possibilities in establishing the context, identification and acceptance of risks, risk evaluation, monitoring and control, risk reporting and mitigation. So this sets the background for the first question. And over to Mr. Ramados. And if I may ask you, what is the level of gap in risk management with and without the support of data?
Good evening, all of you. And I wish a very safe stay for all of us during this catastrophic. It's not a simple catastrophic, it is claustrophobically catastrophic. It's confining everybody inside our homes. Now, even sitting at our homes, we can analyze a lot of data, even in our families. So data has become a new oil. Now, 30 and 40 years before, when I was just a child, or I was in my teenagers, we were not much worried about data in accounting and even in the sense of keeping records in our home. Not to talk about professional firms where they're just keeping only small ledgers. Now, in the last 20 years, you can see the transformation has gone to such a level that no organization, whether let it be small, medium, or large, or even mega enterprises, cannot think about running an institution without a data management. That's why we call data as the new oil. So when we talk about the gap between an organization managing the risk with and without a data support, it's a ocean difference. It's not a small difference, it's an ocean difference. There are a lot of international research reports which says that if you just run an organization, even with proper data, only 5% is being understood. And even with such understanding, we are not able to manage the risk properly. What about to say about organization which does not have a data at all? So to answer this question, I would say in the modern world, thinking an organization without the data support is totally irresponsible and impractical and also very dangerous.
Thank you for that. That brings me to the next question to Mr. Abdul. How do you see leveraging data to serve risk management policies in an organization?
Well, undoubtedly, as you've rightly said, Tamil, and as you rightly introduced, Alok, the new era of big data and digital offers immense capabilities in terms of data aggregation, consolidation, refinement, slicing, dicing, and a lot of tools out there that companies, irrespective of their size, irrespective of their budget, can use actually to deep dive and use data in appropriate way as a basis for building suitable frameworks for risk management. So some of which actually this data is even free, available on the web, which as you said, Tammy, 30 years ago was not even there. So I think that while conducting strategic diagnosis to identify risks, data and business intelligence is either external or internal resource that is supporting the risk management exercise pretty much on the early phase, which is identification of the risks, and more specifically of what we call predictable risks that have a set of measurement which you can actually put a number or dollar value on. Now, I think it's undoubtedly benefit to organization to adopt a data-driven approach to risk management, notably on this phase of predictable assessment, and it helps leadership to concentrate somehow on what matters, which is interpreting the data.
Very good, Abdu. That was absolutely right. And very good approach for the organizations with these insights. And that brings me to the thoughts around what organizations should be looking at, even qualitative risk management or quantitative risk management, including the power of quanta, matrix, or best possible, the robust risk management with data analytics. So the second question over to Mr. Kamal, how risky is to fully rely on data-driven strategy to manage risk?
Okay, so a lot has been said about the importance of data, but we also need to understand the perils of fully relying on the data, because in the modern day with huge big data, there are a lot of data that are not important, that may not be correct. So we need to do a lot of data cleansing and a lot of data massaging, we would say that. But data massaging should not go to an extent of data torturing. So that's another new jargons people are using nowadays. Data torture was not something newly introduced. It was introduced in 1960s by a Nobel laureate economist. So he said that you could even torture the data to an extent to get things what you already clearly determined. So when you deal with data, there are a lot of perils where the data itself could have a lot of unwanted informations which need to be trimmed. Then the people who deal with the data has to be also be carefully selected. So both the data and the people together can give a very valid insight, or it could lead to a very wrong insight. So the most important thing is the inanimate thing called data, and the animate and the logical reasoning personnel called humans. So when the humans and data properly join and marry together, we can get a lot of great insights. But the issue, as I told you, is that data are coming into structured and unstructured formats. So till now, we have a lot of algorithms which can do with a lot of structured data. But there are a lot of unstructured data. There are data related to anthropological, and there are data related to human psychology, which is very difficult to transform into a mathematical numerical value. But still, modern data science is going a long way in also trying to convert these non-convertible mathematical values into mathematical values soon. But still, there is a lot of human bias that could happen in that process.
Absolutely. I agree with you. And having
data.
Yeah, agree with you. Having said that, there are inherent limitations of data. So, Mr. Abdu, how do you see that there are limitations to this data-driven approach? What could be those limitations?
Completely. My take on this is very straightforward, and it will be two highlights. The first one is one must identify key data and build a kind of curated library of metrics to consider, not to fall in the profusion of data, which you could get lost in. As you rightly said, those tools available today are enabled to manage millions of values and data, but one needs really to, I think, build a curated library of what matters, what are the essential metrics. And the second one is more on an holistic approach. I still believe in human, in the sense that, you know, that data-driven approach is good upstream to the decision-making process. In other words, risk management framework is a tool to help management executing the strategy. But at the end of the day, decisions are made by humans. So my word is to say that a wrong assessment with the perfect execution strategy, which is setting you for failure, is not what it could be an outcome, you know, if the data is not used properly, or if the management is just simply taking the wrong bets.
Absolutely, you are right. So analyzing, when we talk of analyzing the possible scenarios and the risk involved with the use of analytics, I mean, that's again a very critical area. So by scenario planning, what do we understand? I mean, it appears very simple, you know. We define a question and create scenarios that address possible futures around that. And but when we talk of risk, risk management, so we believe that, you know, the scenario analysis under the advanced approaches basically should be a very systematic instead of a range-based process of obtaining expert opinions from business managers and involving the risk management experts to derive reasoned assessments of the likelihood and the loss impact of plausible high severity operational or any other losses. I mean, that should be the thing. But again, having said that, we should approach this with extreme caution. And there could be instances where the analytics don't apply. There could be times when the use of analytics is not practical enough. And there are times when we make the decisions, informed decisions or smart decisions, by analytics, they need to be scrutinized. And ultimately, even when the use of analytics does apply, the best decisions will be made by those who combine the science of quantitative analysis with the art of sound reasoning. So, I mean, we need to see, we need to have a very balanced, approach. So, having said that, so, so if I may ask Mr. Tamal, so what is the confusion between correlation with causation? So these are the constant terminologies which are being, rapidly used. So could you clarify the confusion?
Sure. That's a very interesting question, and it's an age-old confusion people have till today. It needs a little bit of statistical analysis and little definitions on that. If you would allow me to throw some definitions on that. You would have all studied in our schools and colleges something called correlation. And a great person called Carl Pearson has defined a formula to calculate the correlation coefficient.
Yeah.
Now, when we talk about data, what we try to see is that how these data are looking in silos and how these data are related. This is how the relational database management developed almost 3-4 decades before, which we call them as RDBMS. So there is no use in having a data in silos, rather the data has to see in connectivity. When we try to see the connectivity, two natural phenomena arises. One is called the correlation phenomena and another is called the causation phenomena. The causation phenomena is very easy for anybody to understand, which is called the cause and effect theory. So when you smoke, you have the chance of developing a cancer. When there is a fire, there could be a smoke. So fire is the cause for the smoke. Smoking is the cause for the cancer. There are a lot of cause and effect relationships which we see in our day-to-day life, in our personal lives, in our business forums and everything. This is very easy to understand. This is called the causation theory. But when we try to link the data, thinking that this data was the reason for that data, we would do a big mistake thinking if those data were really correlated. Statistically, correlation means when there is a relation between two data, but a correlated data not necessarily means there is a causation. So we need to understand, statistically do an analysis of correlation, it should lead next to the integration of the causation for that particular thing to happen. Do not misunderstand, when the data are correlated, automatically there is a causation between them. So causation analysis need to be established with further more detailed scientific study. But most of the times there is a peril that correlated data are misunderstood as causation data. This is one of the greatest skills in data understanding.
Beautifully explained, Tamil. And then on top of it, then there are perils of false positives as well coming in.
Exactly.
And we look at a hypothesis and avian testing and stuff like that. So that brings me to a very interesting question for Abdu, that who should take ownership of this critical role within the organization?
I tend to believe that finance has a key role in driving this exercise, because practically what we're seeing today is that finance is becoming the data vault of entire organization. Not only financial data, but also business metrics data, putting that in perspectives with, other statistics and metrics, be it external or internal, and that makes sense to interpret the performance of the firm or the company. So finance has a key role. I think a facilitator, coordinator of the exercise. However, this exercise should be carried within the entire organization. A risk management framework built with a single approach perspective would be totally useless. You need to have different perspectives from experts, be it operational support functions, and also from external people, because an external eye is also good. When you look at yourself, you might not see things that others see. So I think it's a collective.
A fresh set of eyes are required to give a different perspective. Absolutely.
Right. So it's a collective exercise rather than a single approach.
Yeah, agree. Tamal, so
Yes,
do you
sir.
think prescriptive analytics is a cure for the uncertainty syndrome?
I wouldn't say that prescriptive analytics is a full cure, because sometimes you get a fantastic prescription from the doctor for a wrong disease. So prescriptive analytics has to go a long way, because before the prescriptive analytics, there is a two-stage below that. One is called the descriptive and next is called the predictor. So the descriptive analytics is based on the past data. It tells about what has happened in the past. And the predictive analytics tells about what will happen in the future. Based on the qualitativeness of how did you do the descriptive and the predictive analysis will go the prescriptive analytics. If you do not do the diagnostics of the descriptive analytics properly, and you will not be able to do a proper prediction of the future, and then the prescription also may go wrong. So what we are trying to say that is the great emphasis is not on the prescriptive analytics, is rather based on the more of the two precursors, which is basically the diagnostic and the so-called predictive analytics. So techniques has to be used there so that you can read to a proper prescription. Otherwise, you may get a very wrong prescription for a right disease or vice versa, which is the greatest peril of that particular tool.
Exactly. So how about data torturing, the point which you brought about in one of the questions, one of the responses, and the risk of self-idiosyncrasy? Any thoughts?
Actually, what happened is that the word, the data torture is a jargon brought by the great economist called Ronald Coase, who was a Nobel laureate, actually. He said that in the so-called the research world, the researchers have a tendency sometimes to massage the research data in such a way to prove the predetermined or priori result which they want or intended to have. This happens because people try to misinterpret data or intentionally want to do that. So because of that, too much of reliance of that would be always having a problem. So data torturing is not the problem of the data, it is the people who handle the data. So in huge organizations like banks and financial institutions, when the data are handled by huge IT departments and so-called intelligence departments, the team heading that should be properly selected. We need to do a lot of background testing, because right now the data are in the hands of people. If you don't put the right people, the more danger is there, and not in the data, but in the people who are handling the data, who can really massage the data the way you want. But there are also organizations who are heading the organization who for some immoral reasons or for some intentional and unintentional reasons can do the data torturing to show cause a very predetermined wrong information to the society that can lead the whole market to collapse when it comes to stock market trading or when it comes to pharmaceutical industry research. And right in the COVID situation, you can see that a lot of data massaging has been happening because we don't know whether we are really getting a real cure medicine for that or not. So we do not know. Maybe after 10 years, we'll come to know there has been a data torture in this particular time. So data torture is very strong peril, which we all have to look in. And this can be mostly resolved by hiring very ethical people in managing the data. It's not only the talented people we need, plus more socially responsible and data responsible and more ethical people have to lead the data management. That can to great extent reduce the so-called the bias of data torture. Coming to the false true, or trying to understand there could be the truth, thinking that it is true when it is actually false. So this is called the false truth testing. So this could happen unintentionally, even people who are dealing with the data in a proper way. This can be overcome by repeatedly torturing the data in the good way, not in the bad way. So torturing the data can, for example, if you torture a criminal, you are torturing to him to get the correct news out of it so that you can say the truth. But torturing the innocent is going to be not the good thing. Same way, data is innocent in its own sense. You can torture it to understand the truth, which can avoid false truth.
That
At the same
explanation.
time, do not torture data to that extent that you want to bias it. So be careful with such teams and such groups. So always when we read the data analytics, it should be told with a good story, but sometimes people massage the story in the data in such a way to go to the priori result which they already intend to tell you. So you have to be very careful using huge data when it comes to the data torturing of it.
Agree, Mr. Tamal, and that brings me a couple of the high-risk areas which leaders who are responsible they should address when it comes to the analytics initiatives, especially when it comes to data and information quality, data and information compliance, and of course data and information governance. I mean, for example, even where cases where the third-party services are involved, and especially if there is a inappropriate or even a premature use of analytics or countercultural impact, I mean pushing too hard or even too fast on analytic initiatives. And we need to answer as leaders that how do we measure and quantify risk in the given situations? Haven't we been using analytics for years? Is there anything new with analytics? That is another question which we need to ponder upon. Isn't analytics already built into the enterprise-wide risk management or ERM function? And can analytics help with the financial statements and associated risk reporting? And what role can analytics play in meeting the regulatory requirements? I mean, these are some of the thoughts, which I leave the audience with when it comes to this use of data analytics and, of course, scenario planning and stuff like that. And that brings me to a very interesting topic in the whole of the region, which is about, reviewing the financial risks, considering an inclusive VAT framework. We are seeing VAT in UAE, VAT in Saudi Arabia, and of course, some other countries, VAT will happen. Bahrain, we have the VAT, so on and so forth. I mean, VAT offers a lot of opportunities. The legislation and practices relating to VAT are continuously evolving. And of course, the organizations that manage their risks and maximize their opportunities can anticipate lower compliance costs. They can avoid penalties, optimize reclaimed VAT, and ensure resources are focused on the most productive capacities. If they manage it, the financial risk, considering an inclusive VAT framework in the region. And of course, the VAT is a transaction tax. So we need to know as to how to apply the rules, and there will be opportunities too around the way how we manage the VAT compliance. So, I mean, that is a place where a lot of expertise, will be needed as well. And expertise in the given area is continuously, evolving. So, what are, Mr. Tamal, So what are your thoughts around the financial risk of VAT compliance?
That has been introduced in last years in UAE, and it's just in the infancy stage in the Middle East, I would say.
Yeah.
So even people who had great experience in the background in the home countries who are expatriates in this country still struggling to understand the VAT requirements and VAT rules and regulations. So organizations, right from the SME sector to the large industries, are still in a learning process. So when there is a learning process, there are a lot of chances to do a lot of errors and mistakes. And such errors and mistakes cannot be just avoided without a cost when it comes to the regulatory compliance. So VAT is having a high risk of non-compliance, especially during the early stages, due to two reasons. One is the lack of technology and the lack of infrastructure being in place so that you do not calculate the VATs in a proper way and do not comply with VAT compliance deadlines. Second, proper advisory and expertise support to the organization is missing. So if these two things are not in place and proper, then there is a lot of risk that may run, first of all, in not complying the VAT. This, no need to say, can turn out to be a financial loss, which for SME sector can, in my estimate, can even go to 20 to 25% of the revenue, which is a huge penalty to run a business. So in this very pandemic situation, we should not have another pandemic of not able to comply with our tax rules. So non-compliance is a huge cost for any organization. And my concern is UAE is filled with almost 60% of SME sectors. So having a proper guidance to them is very, very important. And I would request the fraternity of advisory team to extend a good cost-effective service to the SME sector so that you can save them from the perils of non-compliance and the resultant financial losses.
Exactly. I mean, here we also need to take into account, how the errors can be minimized, how the penalties, tax assessment, financial losses can be factored in, and how about the automation in VAT reporting and management. That is another interesting area that we need to look at. And of course, we need to minimize the interpretation risk and the financial losses. And when it comes to choosing the right VAT advisory, either it is in-house or outsourced or from an external party. Isn't it, Mr. Tamil?
Yes. To add on more on that, let me talk about a practical example in my own entities and some of the entities where our colleagues are working. Basically, if you look at our school accounting, people were taught only assets, liabilities, revenues, incomes, and equity, only the 5 streams of classifying the P&L and balance sheet. Later on, the concept of cost centers came in and various types of granularly looking at the expenses come in because of ERP systems. So now if you go for any ERP system, we used to have an expenses being looked into various angles, but what we did is we created almost 35 to 40 codes only for tax accounting separately. Yeah. So that is the greatest work we did when it came to that implementation. Yes, we have a standard rate, we have a zero rate, we have the exemplar rates. These are the very high levels. But when you talk about intercompany transactions, we need to give a separate tax code for that. So you will see that nowadays when a trial balance or a report is extracted in any organization with the support of proper VAT integrated ERP systems, you can derive a tax report where every expenses is codified with a tax code, and you can run a lot of analytics out of it, not only for tax filing purpose, but also for tax analysis and VAT analysis and VAT planning, and how can you really maximize the value of that analytics in the ERP so that you can save the financial loss. And you can see that has become an integral part of the accounting in terms of chart of accounts. It's a very, very granular level we are looking out. So this is the first and foremost thing anybody has to do in their organization. When it comes to
what are your thoughts on the risks in cash flow management, especially considering the volatility in the VAT rates?
Exactly.
Now we are seeing that the VAT rates may be revised. There are numerous things coming around in the media, and there have been changes which have taken place in Saudi Arabia as well.
Exactly. So let me take it two parts. One is basically managing a standard rate of 5%, which is not amended at all, and there is no chances we see for any amendment that may happen in UAE for some time. But even with this fixed 5%, A lot of business organizations are really struggling for the working capital management because, first of all, when you pay the VAT, the outflow of cash is happening. And if the revenue is not collected, then you will have a big cash flow on the working capital management. One of the biggest downfall of the VAT on the businesses, which we could see as a lot of research is happening on that for the last 2 years, is that people have a big issue on the working capital management because of the tax outflow. Yes, it is a transaction tax. It's not an income tax or a direct tax, but there is a time lag wherein I have to take my cash and pay out to the tax authority despite whether I receive the money from my customer or not. And in this very difficult times, collection of receivables has become very difficult. So always there is a big pressure on the cash flow management as such with the standard rate. This is the first thing I want to take into account. Second thing is the volatility. When we are struggling a lot as SME sector or even as large industries to manage the VAT with a standard rate, no reason to say, sir, that how the volatility of the tax rate might affect. Now, you know, already it has become 15% in Saudi Arabia. So because of that, we will surely have to have a very strong planning of, if at all, if you have a scenario of 7.5%. I'm not suggesting any rates, do not take me for granted. I'm just giving a throw a ballpark number. From 5%, it may go for 7.5, it may go for 10, or it can go for 11. So we need to bring in a lot of scenario analysis and think the worst case scenario, and to build, we have to bring him a BMW model, the best, worst, and the most likely scenarios. The worst case, it can go to 15%. The best, it can remain as 5%. Most likely, it can go for 7.5%. We need to look out this scenario analysis and see where do our cash flow and the businesses would go in the worst case. This is the most important exercise one has to do in case of volatility study, because volatility of VAT cannot be taken for granted, Dr. Alok, because it's a compliance. It's not a something like you can just take it as a Vanity Fair and say that I would not want to do it. It's a compliance. So if it is 15%, you have to pay it and you have to take it out of the pocket.
Exactly.
So
no, thank you, Tamil, for that. Yeah, and also that brings to my mind, I mean, we need to have an analytical forecasting of the future VAT rates, and you know, we need to build reserves to absorb the VAT rates volatility and adjust the timing and terms of credit, you know, when it comes to that. So we have all heard about the limiting structures, the limit structures. So a limit framework, also called the risk limit framework, basically that is, this discussion would not be complete if we do not touch upon that. So it is a set of policies basically which is used by institutions, including financial institutions or even otherwise, especially the firms that actively assume quantifiable risks, to govern in a quantitative manner the maximum risk exposure permitted for an organization, be it an individual or even in terms of trading desk or even the business line, etc. So in other words, the limit framework expresses the risk appetite of an institution to assume certain risks. And we need to stay within the risk limits defined by the framework. And so that, you know, we are consistent with the degree of risk the firm is willing to accept while pursuing its business model. And there are various best practices, structures, regulatory expectations, issues and challenges involved around the limit frameworks, especially when we go about to develop the suitable limit structures. So having said that, I mean, my question to Abdul is, to your opinion, what should be considered to develop the suitable limit structure? And where does this model stop?
So to the first question on the key aspects to consider while building these limit structure, as we call them in risk management, I think it's first while executing that risk management framework, one needs to clearly distinguish between the execution side and the assessment side, in the sense that we come back to basics, which is corporate governance, and there is a need to have the executives which are incentivized on the risks they are taking and which are actually the one executing the strategy and acting on behalf of the shareholders to be distinguished from the body or the organ within the organization that is going to assess, validate the directions and the level of threshold of risks which has been validated through the risk management framework. It's very important when you have blurry lines, or let's say when it's not very clear, then this is where you could potentially, you know, have some very bad surprise when it comes to corporate governance and in that aspect. So I think it's very important. And the second one, it's somehow trying to think a bit differently about risk management approach, in the sense that I don't like much the term limit structure, because it gives you the idea that it's boundaries that you are setting aside. But if we think about differently, while taking risk, or within an environment as dynamic as we are today, which is somehow a chaos from an economic standpoint, you know, chaos is always made of catastrophe and opportunities. And I believe if one sit to the traditional approach to risk management and the boundaries and limit structure, companies could actually, you know, forbid themselves from taking some strategic shifts, which will be extremely beneficial in the long term. So I think we need to think also, and that's really about leadership here, shift from exploit approach to explore approach a bit, and integrate that into the risk management framework, not to miss anything. I think there are a lot of companies today that are taking, you know, huge strategic shifts because, well, they rightly reassess, you know.
Agree with you. And so when we define the risk limit structures, Mr. Kamal, I mean, there are issues around overcoming fear, developing courage, and, you know, leading to risk conviction and so on. So what are your thoughts around all this?
Traditionally, if you talk about risk management, there are various stages. The first stage is risk identification. Then the thought of data analytics risk identification has gone a long way, and it has gone to a very high stage where identifying the risk is becoming a little more easy. Now, the next thing is, how do you manage the risk? To manage the risk, you have to rank them. To rank them, first you have to quantify and qualify the risk. When you quantify and qualify the risk, what happens is that you develop a very traditional probability impact matrix. Yes, that's where we reach. Most of the risk management framework stops there, and then they take a response. Now comes the response stage, where most of the organizations have not integrated the limit structures because they think that limiting that particular with the structure is not possible for them. Most of the organizations where I work, they have not incorporated the limit structures there. So what I would say is that there are two types of risk. One is the known unknowns, one is the unknown unknowns. One is the known risk and one is the unknown risk. As Mr. Abdurrahman was telling, instead of exploiting, we need to explode. Is that right? Yes, I'm agreeing with that. But what I'm trying to say is that out of 100 risks, almost 80% of the risk might be known unknowns, where we need to set the limits and we need to limit with a structure so that we can exploit that. The remaining 20% of the unknown unknowns, we call them as the unknown risk, and like the COVID or something else, which is very, very, very catastrophic and claustrophobic and very, very unexpected. We cannot limit anything to structures. So whenever we're talking about academically and practically limiting through structures of the risk, is that only for that 80% of the known unknowns, which is also not happening mostly for 50% of the entities in the world now. So what we are trying to say is that we need to incorporate, it's a time to incorporate the limit structures in your risk management framework for the so-called known unknowns, which is called the known risk, so that you will take all the risk with your own levels of acceptance. Yes, it is a conservative approach, but at the same time, you are taking the risk with a known structure. But this will not apply, as Mr. Abdurrahman said, for the unknown unknowns. So for that thing, we cannot have any limit structures, but we should have the only choice of exploring it. So the say goes is that please start incorporating the limit structures in your risk response strategy. Do not stop only with your risk quantification.
Exactly. And even the risk limits, they should be specific and sensitive. to the actual portfolios. They should be measurable, and they should be frequency based, they should be reportable, and based on forward looking assumptions, preferably. And having risk limits that are measurable can prevent an organization from unknowingly exceeding its risk capacity as market conditions change, like in today's COVID-19 times. And that can be an effective defense against excessive risk taking, I mean, and we need to consider the organizations, the interactions between risks within and across the business lines when we are setting up these structures, and they should be correlated or compounded with impact on exposures and outcomes as well. I mean, this is what I would like to add on to what Mr. Tamal and has already said, and Mr. Abdu has said. And we need to establish the risk limits for the business lines and the legal, and especially including the support functions, especially expressed as, for example, if you ask me the metrics, for example, the key areas include, which are expressed as relative to earnings, even capital, when it comes to liquidity, or in terms of any other relevant measures like growth or even volatility, and material risk concentrations, so on and so forth. And at a counterparty level, at an industry level, country level, regional level, collateral level, product types, so on and so forth. And these again should be referenced against the market best practices and benchmarked. And they should not be overly complicated, I believe. They should be monitored regularly. They should be simple and objective rather than being, subjective. And I think for them to be very helpful, I must say. And so how about stress testing, Mr. Tamil? Any thoughts around that?
Yeah, as I told you that when you start fixing the limit structures, the level of stress an organization can take will be well analyzed. So all the risk cannot be going for a high level of acceptance. So when you cannot do a stress testing unless first you incorporate your so-called limit structure into your risk management philosophy. So risk integration should happen with the limit structures. Then you go to the stress testing where you can understand what is the maximum level of risk that this organization can face. There is no point in the high level of limit structure with of no benefits back to your organization. It is always a cost benefit analysis. Risk management is not just blindly taking a risk, it's a calculated risk. When we talk about calculated risk, there has to be surely a calculated benefit flowing back to you that can be done only through a proper stress that an organization can bear, which can be done through various tools of stress testing.
Yeah, that's right. So that brings me to a question raised from the audience that while this is for you, Mr. Tamil, while defining risk limits, basis detection and identification, and doing risk management, what about element of fraud, which is inherent in every risk? And how do you manage this in your organization?
I've been in audits and I've been also been auditee. So frauds are inherent in any organizations because we can avoid errors, which is a human non-intention. But fraud is an intentional mens rea. So there's an intentional element. How much ever risk mitigation strategy you may take, there is always a chance that you may not 100% avoid the frauds. So what we try to understand is that, first of all, try to create a human element so that you can, right from the recruitment of the employees, and I'm talking about internal fraud management, you can have a lot of process of screening so that you can minimize the chance of having the fraud risk in your organization. But at the same time, you need to have a small allowance of accepting that fraud risk, which is, we can call it as to a structure of depending upon your revenues, depending upon the areas in which, for example, if you're talking about asset management is one of the very prone areas for mismanagement, wherein even with RIFD tracking of the cars where it is moving, whether the car is used for the right purpose, RFD cannot track it. So frauds cannot be 100% eliminated even with the data management or data analytics or robotic systems. So what I'm trying to say is that we need to have some sure allowance. I cannot throw a ballpark percentage on that, but for sure your limit structure should include some allowance for the fraud, because as long as people survive in the world, as long as systems are there, still people will for it, and the chance of frauds will always be there. But we have to minimize it, but not over minimize and take a lower structure, depending upon your vulnerability to the fraud in your organization and the people ethics systems in the organization. You need to have a higher or a lower range of limit structures for that. For sure, you need to allow for that.
Yeah. So over to Abdul. So what are your parting thoughts on on the topic as a key takeaway for the audience in terms of the strategies to mitigate risk?
Well, I think that it's to your question. It's funny because we are talking about risk management, which is really anticipating and trying to be to have some outlook, to be to envisage things, while we are today in very uncharted territories where level of predictability is far from zero. It's at minus whatever. And I think my best take actually to the people today is forget about, whatever you have said, and really one needs to be open-minded, needs to listen to what's going on in the market. Of course, there are some basics, as you said, limit structure that are there. But my point is that don't, make your organization enslaved by this, because to survive in those uncharted territories, one needs innovation, one needs to be creative. And risk management frameworks tends to lock creativity. So it's very important to have that open-minded approach and really try to explore things rather than just keeping on doing the same cyclical things that you used to do before, because in this period, you won't be called to do whatever you do before. I mean, you'll hit the wall probably before you finish the next cycle if you keep on doing the same thing that you used to do in the good old days, because those are not anymore good old days. God knows better than anyone what the economical landscape would look like post-COVID. And and that's why it's important to have that level of sensitivity to that.
Good point. Thank you. And Mr. Tamal, over to you. So we are living in very uncertain times, especially during this pandemic, and organizations, businesses, everywhere there is a lot of uncertainty around, and risk management, as we have discussed during this interaction, has assumed a very high importance. Never before it was as important as it is today. So what are your key thoughts as we move towards the end of this webinar, or rather the key takeaways in terms of what are the 3 to 4 things the organizations need to focus on in terms of the risk management?
Yeah, I would like to take the quote from Mark Zuckerberg, who said that the person is taking a high risk, but by not taking a risk only. So in the era of risk-filled environment, even if you don't want to embrace the risk is sitting in the doorstep. So what we should do in such a stage, and what should we do about managing the risk in such a very, very claustrophobic situation, is that, first of all, build up a very robust risk management internal framework system to protect you, the first line of defense. Because whether the risk is going to be fully manageable or you will be able to control it or not, take the first step of having a very integrated framework system in your organization. That is the rule number 1. First thing comes first. Whether we are going to have the job tomorrow or not, we have to do our daily eating of food, daily exercises. These are our first level of taking care of our health so that we don't get into depression. The same way, an organization should not get into a depressive mode because of a very big pandemic or a situation is happening. It can protect itself as first line of defense with proper internal framework policy and outlook. Second thing is, try to embrace a lot of data-oriented thinking in your organization. Risk is always about future thinking, future uncertainty. Always risk was hungry for understanding the future. Now we are in a better situation to manage the risk because there is a lot of food for the risk to be given that is called through data. So in those days of 20, 30 years back, there were a lot of risk. We had underwent a lot of world wars. We underwent a lot of great depressions. In those days, what they were not having, we still have today is that the data. So why can't we use this data, which is a great thing, as a great boon to face the uncertainty? Yes, all the data analytics cannot lead to the unknown unknowns, but most of the organizations are failing to understand even to manage the known unknowns, the known risk. Why? Because they do not have a data-driven organization. So let's have an integrated risk framework, then have a data-driven organization, little bit invest on data analytics, train your people on that so that a small person working in the corner of your computers can come out with a very, very fantastic scenario, which could be a great boon for managing your risk. This is the second step. The third step is, as Mr. Abdul was telling, that we need to be in an exploitative situation when you are encountering a very, very unknown risk of which we never encountered before. In such situation, all your internal frameworks, all your data analytics might fail. But what would take you forward is only the courage. So the courage cannot be given by data, courage cannot be given by internal risk frameworks, but courage can come only by great leadership. So an organization which has the first line of defense, that is called the internal risk framework, the second line of defense of embracing technology and data, and the third level, the greatest defense is called the leadership. If all three together will concatenate or it will be constituting in a proper combination, I would think that any pandemic, any catastrophic can be well overcome by such organizations. This is my conclusion on that.
Yeah, Mr. Tamal, that brings me to one last question. Is it not taking the risk, the biggest risk under the current situation?
Yes, because now the risk is what? The risk is we are not coming out of homes. Yes, what we can do within the homes? We can upgrade our skills. How can we think about running the same business on online? So a lot of innovative thoughts has come during this time. So every sickness, every depression, every risk as an opportunity. We always look at the negative side. We are not looking at the positive side. Enough is enough with the negative side. Let's look with a more positive outlook. Let's come out of our very claustrophobic situation. Let's not be constrained. Yes, constraining is going to make you only as a great, it's going to be a death to you. So let's not be death, let's be having life. So let's have life with very positive thinking, but with a very calculated risk. By positive thinking, you should not take many very, very unwarranted situations. You should take a very calculated risk. When you're talking about calculated risk, data comes into support. Risk management policy comes into your support, and great leadership will always take calculated risk. So I would say, combining all these things, we should have a very positive outlook, and inshallah, post-COVID, and also during the end of this COVID, we should have a lot of risk management policies taken and risk appetite should be taken, and we should have a very positive with a calculated risk appetite.
No, thank you, Tamal, for your thoughts, and thank you, Abdul Rahman, for your thoughts as well. They are highly appreciated, and I'm sure the audience will go home with a lot of thoughts in their mind about the strategies to mitigate risk and creating a risk management framework. It's the beginning, it's not the end, and the risk management world continues to evolve, into the pandemic and even beyond the pandemic, especially with its continuing relevance. So I believe, it has been a very interesting discussion. So thank you, everyone, and especially a big thanks to the entire audience for their questions and for their hearing. And we hope we have been able to add value during this interaction, myself and both the panelists. So without further ado, thank you, everyone. And I hand over the mic back to Rion as we approach the end of the webinar today. Thank you, everyone. Over to Rion.
Thanks a lot, Dr. Alok. Thanks.
Thank you very much, Alok, for leading that very insightful session. And thank you to Abdurrahman and Tamil for joining us here today. That is the end of the third webinar of the series. The webinar will be accessible via our website for on-demand viewing within the next 24 hours. If you do have any questions, please feel free to get in touch with us via our website. and please keep an eye out on our website for the release of our next couple of webinars. Thank you on behalf of the Accounting and Finance Show team to all of our panelists and our moderator for joining us and for taking the time out of your schedules. And also thank you to all our audience members for tuning in. Enjoy the rest of your evening, everyone. Bye-bye.
Thank you.
Thank you.